Target just sounded the alarm bell that the U.S. economy is on the brink of collapse. The retail giant's recent warnings about declining consumer confidence and tariff uncertainty aren't just corporate jargon. They're the canary in the economic coal mine. Target's stock has plummeted a staggering 32.4% over the past year, while the broader market gained 6.9%, signaling a retail apocalypse that historically precedes major economic contractions. What Target knows and isn't fully disclosing is that we're witnessing the first dominoes fall in what could become the most significant economic downturn since 2008. The numbers don't lie. Retail sales revised downward to minus 1.2% in January. February sales barely climbing 0.2%. And the Atlanta Fed slashing Q1 GDP forecast to an alarming minus 2.8%. These aren't random fluctuations. They're the warning signs that savvy investors and homeowners need to recognize before the mainstream media catches up to the reality. Welcome to today's deep dive into what Target's economic warning means for your investments, your real estate holdings, and your financial future. I'm going to walk you through exactly what Target executives revealed in their latest statements, what the market data is telling us behind the headlines, and most importantly, the specific actions you need to take now to protect and potentially grow your wealth during this coming economic storm. By the end of this video, you'll understand why Target's warning is just the tip of the iceberg, how this retail sector collapse will inevitably impact housing markets across the country, and the strategic moves that could mean the difference between financial devastation and opportunity. Let's examine what Target executives revealed in their recent statements. On March 4th, 2025, Target's CFO Jim Lee stated that declining consumer confidence impacted our discretionary assortment overall. This wasn't just casual observation, it was a calculated warning to investors. The numbers tell a concerning story. Target's comparable sales rose just 1.5%, propped up by an 8.7% jump in digital sales, while in-store sales declined by 0.5%. Their net sales dropped 3.1% year over year to $30.9 billion, and operating income plummeted by 21.3% to $1.5 billion. Payment method changes across the retail sector are especially telling. According to industry data, buy now, pay later services like Affirm, which partners with Target, saw a 40% increase in transaction volume during the last few months. This surge in installment payments for everyday purchases signals financial strain among consumers. What makes Target's warning particularly alarming is that they're not alone. Walmart recently cautioned that 2025 would be a rockier year amid concerns about inflation and tariffs. Home Depot has similarly raised red flags about weakening consumer spending. When the three largest retailers in America are simultaneously warning about economic headwinds, it's time to pay attention. The broader retail economy data confirms these warnings. According to the U.S. Census Bureau, retail sales in February 2025 were up a mere 0.2% from January, well below the expected 0.6% growth. January's retail sales were revised downward from minus 0.9% to minus 1.2%. Consumer confidence registered its biggest monthly decline since 2021 as inflation fears have begun creeping back. Adding fuel to this economic fire is the emerging global trade war. President Trump's blanket 25% tariffs on Mexico and Canada took effect in March, and he doubled the tariff on Chinese imports to 20%. These three nations collectively import more than 40% of all U.S. goods by value. Target specifically cited tariff uncertainty as a factor that will impact their profit this quarter. The stock market often serves as the most immediate barometer of economic health, and Target's stock performance is alarming. Target's stock has plummeted an astonishing 32.4% over the past year. For comparison, during this same period, the broader retail sector ETF declined by only 8.6%, while the S&P 500 actually gained 6.9%. Looking at Target's stock chart reveals a troubling pattern. The stock hit a high of $156.16 over the past year, but has since fallen to around $105.52, hovering dangerously close to its 52-week low of $104.36. The trading volume tells an equally concerning story, with Target's average daily trading volume surging to over 96 million shares, significantly higher than historical norms. But Target's stock performance is just one piece of a larger puzzle. The Atlanta Fed has slashed its Q1 2025 GDP forecast to minus 2.8%, a dramatic downward revision that suggests we're already in the early stages of a recession. 2 consecutive quarters of negative GDP growth is the technical definition of a recession. What's particularly concerning is how closely the current market conditions mirror previous pre-recession patterns. In late 2007, we saw similar divergence between consumer staples retailers and the broader market, followed by downward GDP revisions before the full extent of the Great Recession became apparent. The technical indicators for Target's stock are equally troubling. The stock is trading well below both its 50-day and 200-day moving averages, a classic bear market pattern. Despite these concerning metrics, analysts still maintain a buy rating on Target with a price target of $150. A disconnect between analyst optimism and market reality that often occurs in the early stages of major market corrections. Now, let's examine what Target's economic warning means for the housing market. According to JP Morgan research, the U.S. housing market is likely to remain largely frozen through 2025, with price growth expected at a very subdued pace of 3% or less. When consumer confidence plummets and retail spending contracts, as Target is warning, housing demand inevitably follows suit. The numbers paint a concerning picture. January 2025 sales of newly constructed single-family houses fell 10.5% compared to December 2024 and 1.1% compared to a year ago. Zillow has already revised down their 2025 housing market forecast to just 0.6% price growth, a dramatic reduction from their earlier projection of 2.9%. Mortgage rates are expected to ease only slightly to 6.7% by year-end. This higher for longer interest rate environment creates a lock-in effect, where more than 80% of current homeowners have mortgage rates at least 100 basis points below current market rates, creating a significant disincentive to sell. What's particularly alarming is the inventory situation. New homes for sale have reached 481,000 units, the highest level since 2007. While speculative homes for sale have hit 385,000, the highest since 2008. These metrics are approximately 50% and 40% above their long-term averages, respectively. The historical pattern is clear. Retail sector contractions typically precede housing market corrections by 6 to 12 months. We saw this in 2007 and 2008, when major retailers began warning about consumer spending months before housing prices started their dramatic decline. We're seeing the same warning signs today, but with housing prices significantly more inflated relative to incomes than they were even at the peak of the 2007 housing bubble. Given Target's warning and the supporting market data, let's discuss specific protective measures that savvy investors should consider implementing immediately. These aren't panic-driven reactions. They're strategic adjustments that have historically preserved and even grown wealth during economic contractions. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. The traditional 60-40 stock-to-bond portfolio needs recalibration in this environment. Consider increasing your allocation to defensive sectors that historically outperform during economic downturns. Consumer staples, utilities, healthcare, and select dividend aristocrats have demonstrated resilience in previous recessions. During the 2008 recession, while the S&P 500 dropped 38%, consumer staples declined only 15%, utilities fell just 21%, and healthcare outperformed with a 23% decline. For the fixed income portion of your portfolio, consider shortening duration to reduce interest rate risk. With the yield curve currently inverted, short-term treasuries are offering attractive yields with less risk than longer-dated bonds. Treasury inflation-protected securities, TIPS, also merit consideration given the inflationary pressures that often accompany tariff implementations like those we're seeing now. Cash deserves a place in your defensive strategy. While conventional wisdom often dismisses cash as trash during inflationary periods, it becomes invaluable during market corrections by preserving purchasing power for strategic acquisitions when assets are discounted. Consider maintaining 15 to 20% of your portfolio in high-yield money market funds or short-term CDs to capitalize on opportunities that will inevitably arise. Alternative investments warrant consideration for accredited investors. Private credit, select hedge fund strategies and structured products designed to provide downside protection can offer valuable diversification benefits when traditional asset classes become highly correlated during market stress. The timeline for implementing these protective measures is critical. Historical data suggests that once major retailers like Target issue explicit warnings about consumer confidence, investors typically have a 3 to 6 month window before broader market recognition triggers more significant corrections. This doesn't mean liquidating quality long-term holdings, but rather strategically repositioning to reduce exposure to the most vulnerable sectors. For home buyers and real estate investors, Target's economic warning presents both challenges and strategic opportunities. Let's examine specific approaches to protect your real estate investments and potentially capitalize on the coming market shift. Timing is perhaps the most critical factor. Based on historical patterns following retail sector contractions, we can anticipate a 6 to 12 month window before housing prices fully reflect the economic reality that Target is warning about. This doesn't mean waiting indefinitely, but rather approaching the market with strategic patience and heightened selectivity. Geographic diversification becomes increasingly important. Markets with diverse economic bases, strong healthcare and education sectors, and less reliance on discretionary consumer spending tend to experience milder corrections during economic downturns. Research shows that cities like Austin, Raleigh-Durham, and certain Midwestern markets maintained relative stability even as overheated markets experienced double-digit declines. For those looking to purchase in the next 12 to 24 months, developing a robust negotiation strategy is essential. The data suggests a shift from a seller's market to a buyer's market is already underway. This transition typically follows a predictable pattern: increasing days on market, followed by price reductions, followed by greater seller concessions. Property type selection becomes increasingly important during economic transitions. Single-family homes in middle-income neighborhoods have historically demonstrated greater price stability than luxury properties or condominiums. Income-producing properties with long-term leases to credit-worthy tenants offer both cash flow protection and potential appreciation when the market eventually recovers. Let's recap what we've uncovered today. Target has explicitly warned about declining consumer confidence, tariff uncertainty, and a meaningful profit drop. Their stock has plummeted 32.4% over the past year, while the broader market gained 6.9%. Retail sales are stagnating, with February growing a mere 0.2% and January revised down to minus 1.2%. The housing market is showing alarming similarities to pre-2008 conditions, with inventory levels at their highest since 2007 and Zillow slashing their price growth forecast to just 0.6%. These aren't isolated data points. They're interconnected warning signals that historically precede significant economic contractions. The last time we saw this particular combination of retail warnings, declining consumer confidence, and housing market vulnerability was in the months leading up to the 2008 financial crisis. The difference today is that you have the opportunity to prepare before the full impact is felt across the economy. The actions you take in the next 30 to 90 days could determine whether this looming economic storm erodes your wealth or becomes an opportunity to strengthen your financial position. For investors, this means strategically repositioning toward defensive sectors, maintaining adequate liquidity, and considering alternative investments that have historically preserved capital during downturns. For homeowners and real estate investors, it means approaching the market with strategic patience, focusing on geographic areas with economic resilience, and implementing sophisticated negotiation strategies as the market shifts in your favor. Don't make the mistake of waiting for mainstream financial media to catch up to what Target already knows. By the time economic contraction becomes the consensus view, the most advantageous positioning opportunities will have already passed. The most successful investors in history built their fortunes not by reacting to economic shifts after they became obvious, but by recognizing the early warning signs and taking decisive action. If you found value in today's analysis, please share this video with others who might benefit from this information. The coming economic transition will create both challenges and opportunities. Those who prepare now will be positioned not just to weather the storm, but to emerge stronger on the other side. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.